If you're like most people, you might have picked up not-so-great money habits. Yet, by grasping key concepts early, you're on track to attain wealth. Learning these skills when you're young makes it much easier to do well. But if you don't learn them, you might have a harder time. You should learn these important ideas about money as soon as you can. Stay until the end to hear about one concept that will really change how you think about money. To achieve financial freedom and relieve money concerns, be sure to subscribe and like the video if you find it beneficial. Number 1. Net worth. Net worth shows how well you're doing financially. It's like a summary of what you own, like money and things, minus what you owe, like debts. This helps you understand your money situation better. Monitoring this number from a young age and seeing how it changes can really help. You can easily see how you're doing over a long time, which is hard to do quickly. Having a positive net worth is advantageous, but many face a negative net worth, requiring effort. Keeping track of your money situation is important to see how you're getting better each year, even if it feels like you're not getting anywhere every day. Number 2. Liquidity. When determining where to allocate your funds, grasp the concept of liquidity, the ease of accessing your money. Cash or bank deposits offer high liquidity, swiftly accessible at no charge. Conversely, retirement accounts hold advantages, yet lack liquidity. IRAs and 401k, designed for retirement, entail penalties for early withdrawal. Withdrawing from volatile investments also jeopardizes capital. While investing is beneficial, remember that the funds may not be easily accessible in the short run. Ensure you have adequate savings to avoid the need for immediate withdrawals. Number 3. Inflation. Most people know that inflation makes the dollar's buying power go down, but there's more to it. When things cost more, your dollar doesn't go as far. If inflation is 5% a year, your dollar is only worth 95 cents after a year, and it's worth only half as much in around 14 years. This is important when talking about your salary. If your boss gives you a 2% raise each year, and inflation is 5%, you're actually getting 3% less money because things cost more. So even a 5% raise doesn't really mean you're getting more pay. Unattended cash in a bank account often erodes due to inflation. If your savings account yields 2% interest, while inflation reaches 5%, your purchasing power diminishes by 3% yearly. Although inconsequential for short-term and small sums, it's crucial for longer durations. Number 4. Compound interest. Albert Einstein is famous for saying that compound interest is like a magical 80 wonder of the world. If you understand it, you make money, but if you don't, you end up paying. The amazing thing about compound interest is that when you invest money, it grows faster and faster, helping you build up wealth. Over time, your money grows because you earn extra money on the money you already earned. Most of your savings come from this extra money, not just the money you started with. Compound interest helps your savings grow a lot, and you don't need to put in a lot of money at the beginning. If more people know about this, they might start investing even a little money regularly. Number 5. Risk tolerance. Know how much risk you're okay with when investing. Think of the stock market like a roller coaster. Risk tolerance is how comfortable you are with its ups and downs. If you're okay with big drops, you might invest aggressively when the market crashes. But if you're not comfortable, you might avoid investing or be careful. Your age and how much money you'll make in the future also matter. Taking too much risk could make you lose everything, while too little risk might stop you from earning more over time. If you invest in the S&P 500, remember that its price usually goes down by a lot, around 20% or more, every 4.5 years on average. To keep things balanced, you can choose target date funds or an S&P 500 fund. Number 6. Time value of money. The time value of money asserts that money's worth is greater today than in the future. Money can be invested to compound over time, making a dollar earned now more valuable than one earned later. Choosing to spend or invest a dollar today leads to different outcomes. Investing $1,000, for instance, with a 10% annual S&P 500 return over 30 years, could grow to over $3,000, adjusted for 4% inflation. This perspective encourages more thoughtful spending decisions. Number 7. Market crashes. Market crashes are a regular part of the financial landscape and shouldn't make you worry too much. When these drops occur, People sometimes get scared and sell their investments quickly, which actually makes their losses worse. These drops, which are when prices fall 25% from their highest point, happen a lot and investors should expect them. It's smart to know about this before putting a lot of money into investments, so you don't react without thinking. Historical data shows that the S&P 500 has experienced 22 instances of 20% or greater declines since 1928, occurring approximately every 4.5 years. On average, it takes the market 388 days to recover from a bear market. Remember, these things aren't unusual and they don't mean something really bad is happening. So, selling everything in a panic is usually not a good idea if you want to become wealthy over time. Understanding these crucial money concepts is not complex. However, the sooner you grasp them, the more advantageous it is. Avoid regretting the delay in learning these essentials when you're older.